Everyone. Thank you for joining us. This is McQueen Financial Advisors CECL presentation. We appreciate everyone being here today. First, a little bit about McQueen Financial Advisors. We are an SEC registered investment advisor with a little over $6 billion in assets under management. We also do lots and lots of valuation work involved in many credit union mergers. Also, we're involved in the very first purchase of a bank by a credit union, and we have all sorts of other valuation services. We run our own in-house asset liability management model with all the related services and do a variety of consulting work. Today, of course, our topic is CECL. We offer a complete CECL solution, and we'll also be offering CECL review services if you're using someone else's model or have an in-house solution that you're working with. I'm Jim Craven, Vice President with McQueen Financial Advisors. I've been in the industry my entire career in various roles and been with McQueen Financial for upwards of 14 years. We have an abbreviated session today. For anybody who has ever attended a webinar, a conference, anything like that, and talked or heard a talk about CECL, you know that we could spend easily 2 hours talking about CECL and we wouldn't cover everything. Today's session is 15 minutes long, and so let's get right to it. We'll talk first about the implementation date and timeline, which of course is the first quarter of 2023, and our reasons for believing that that will not change. We already provide reporting services to many clients. We have a strong understanding of data needs and also the challenges that data will sometimes present us. We also have already formulated some opinions about post-implementation challenges, and we'll talk about those, and then also guide through some keys to success. So the implementation date is the first call report of 2023. That may seem like a long way off, but the time to get moving is right now. There is plenty to do. It is our belief that CECL will not be delayed again, and we have a variety of reasons for thinking that. CECL, of course, is accounting guidance. It is not regulatory guidance, and CECL, of course, applies to all companies that hold financial assets. And we are not aware of any accounting guidance that differs based on a company type. In their July board meeting, the NCUA covered CECL extensively, talked about implementation and costs and so on. It's our belief that the CECL standard will not be delayed again, and credit unions will not be exempt from the standard. Here's our implementation timeline, and we should already be well on the way. Since we're late in 2020, we should be well on the way with some education, planning, assigning certain people internally who are going to handle the CECL effort, and we should already be taking a very close look at data, and our data discussion will follow in a couple of moments here. It's probably not too early to already be talking about selecting a model, whether you do it internally or externally, and talking about calculation methods. Of course, along the way, we need to be making adjustments and determining the impact that we will see on our capital. So under the category of CECL data needs, one of the key takeaways here is that segmentation is a very important exercise, and we'll be talking about each one of these early on. Then once we determine segmentation, there are only really three things we need for CECL. We need historical losses, we need what we call current condition adjustments, and then we need forecast adjustments. Historical losses are the first step, and then thereafter we look at the condition of the actual loan pool to determine if there's any reason to adjust the historical losses higher or lower. Then we look at external factors like the unemployment rate or some other factor that's external to us that may impact potential losses going forward. Segmentation, as I mentioned, is a very important exercise, and we should be thinking about this already and maybe already doing some preliminary segmentation. Again, we are working with many clients, and we have seen, a number of stress points and challenges. Some CECL segments have zero losses for many, many years, or sporadic losses that don't seem to have any pattern related to them. We've also seen many, many small categories that really should be grouped together for CECL purposes. This is a big takeaway here, is we should be assigning or deciding loan segmentation now, segmenting things by similar risk, thinking about which categories may grow or shrink over time. Certainly, indirect autos should be separate from direct autos. Segmentation here should not be too large or too small. If we have segments that are very, very large, the losses may not seem meaningful amongst a large category. But if they're too small, that is potentially even a larger problem. If we had a very small category and had one or two losses, that might be a large percentage of the total segment, which could carry forward and be with us for a long time. So segmentation is an important first step. Once segmentation exercise is done, the first thing we need to look at is historical losses. What we have found is that historical loss records rarely match up with our segmentation exercise. As a couple of examples, a client's current method might include two categories of maybe retail loans and separately real estate loans. Those are too broad for CECL needs, and the historical data, the historical loss data may not match up with what we need for CECL. So it's important to be looking at this very early. We should already be doing this. This has been one of the largest challenges that we face with our clients, is getting the historical data matched up with the current CECL segments. Most clients will tell me, oh, our loss history is very thorough, but what we find out in reality is the record keeping will not easily convert to the CECL segments that we have. As another example, we might find that the historical loss information includes a category called auto loans, but we don't know from that data whether or not we're looking at used cars, new cars, or indirect autos. And we need that information going forward for CECL. Once we have the historical losses, the second thing we need are what's called current condition adjustments. There are many methods available, and these current conditions adjustments just answer the question for us: is there anything going on with this loan pool, the trend, that would lead us to believe that losses will be better or worse going forward? Now, current condition adjustments are fairly straightforward. We can measure several things: concentration, delinquency, non-accrual status, changes internally to the staff, or lending policies could also be a reason to make adjustments. And again, adjustments can be positive or negative. Some of the challenges we found is that off-system loans may not have the same sort of data fields that on-system loans would have. They might not be available at all. And we've also found that the non-accrual loan status is not clearly defined. There isn't strong regulatory guidance about what we call a non-accrual loan, and so we need to have those decisions made so we can measure the trend over time. We should also make sure that we're recording recoveries in the year of the recovery and not as an adjustment to the year of loss. So that is the second step of CECL, is assigning or adjusting the historical losses for what we call current condition adjustments. Again, anything within this loan portfolio that would lead us to believe that losses are going to improve or deteriorate going forward. The third thing we need is what we call forecast economic factors. Now, this is answering the question basically: is there anything going on externally in the economy or with housing values that may impact losses going forward? Many indicators can be used for this, and we have tested all sorts of things to determine what is the largest correlation between some economic factor and losses. And what we found is that there is a very strong correlation between the nationwide unemployment rate and industry-wide credit union losses. We've tested many other things, including state unemployment rates, and didn't find a large correlation. We've also tested housing values and many other things. But the biggest correlation we found was between the nationwide unemployment rate and industry-wide credit union losses. So we encourage you already to be looking at these relationships, and also consider that there may be things internally or in your footprint that may impact losses that are separate from the unemployment rate. We also recognize that certain loan types would be impacted by factors that do not impact other loan types. For instance, housing values may go down, and that would not necessarily impact the losses that we expect on auto loans. So these are just some things to think about. Now, once we get that together, those are sort of run up to implementation, everything we've just talked about. Now we want to talk about post-implementation challenges. And we think that every single credit union is going to face these types of challenges. We've chosen here a current condition adjustment using a measurement method of the percentage of loans that are delinquent 60 days or more. This is just one of the current condition adjustments that can be measured. This is actual client data. We're very fortunate to have it running back many years for each of these categories. So the first challenge is we look at this and we notice that the 60-day delinquency rate is trending higher in every single category. And in most categories, it is triple where it was in 2013. So our challenge here, our first challenge, is to determine which one of these categories, if any, we might want to say is deteriorating to such a degree that we want to make an adjustment. Meaning, since every category is showing higher delinquency, we should be considering whether any of these need to make an adjustment, meaning a higher allowance in these categories. This is a big challenge. Which categories should be adjusted? The next challenge is how much of an adjustment should we make to the category? Is it 10 basis points, 25 basis points, 40 basis points? What is the number? We see that used indirect auto, that trend is really quite troublesome here, and we would definitely make an adjustment there. But our challenges are deciding which category to adjust and how much to adjust it. The other third thing that is a challenge is making a written rationale for these choices. Why did we choose to make an adjustment in one category versus another? And why did we make the adjustment percentage in basis points that we did? Again, big challenges that every single credit union is going to face. So on more keys to success going forward, the term reasonable and supportable is written throughout regulatory guidance. And what that tells us, basically, is that we need to develop an adequate written rationale for model methods and assumptions. By model methods, I mean, why did we choose the vintage method or the weighted average maturity method? And then why did we use the unemployment rate and so on as the, some of the factors that we look at? Institutions are allowed to use judgment in determining relevant information appropriate methods. This is where CECL gives us a great deal of flexibility. We can use a number of methods that are appropriate for us, and as long as we describe them adequately, we have done what we can do. No examiner should suggest any preferred method. Our first exam cycle, this is actually written in regulatory guidance. Our first exam cycle should include basic questions, and thereafter we can expect more detailed examiner scrutiny. Examiners are already asking about CECL, and we know that we should have a package of information, some documentation about our methods and rationale, and we should be doing that now so we have something to give to examiners. Again, I'm Jim Craven from McQueen Financial Advisors, and we appreciate you being with us, and you have my contact information